Welcome. Today we are looking at foreign trade, focusing on import and export procedures. This is a key topic in your commerce exams for SS3. Pay close attention. Let us begin. First, let me explain the meaning of foreign trade. Foreign trade is the exchange of goods and services between countries. It is also called international trade. Foreign trade is divided into import trade and export trade. Import trade is the purchase of goods from other countries. Export trade is the sale of goods to other countries. Foreign trade is essential for economic development. It allows countries to obtain goods they cannot produce. It allows them to sell their surplus products. It promotes specialization. It brings in foreign exchange. Foreign trade involves more complex procedures than home trade. It requires additional documents. It involves customs duties. It is affected by exchange rates. It involves risks like currency fluctuations and political instability. Now let me explain the procedures for import trade. Import trade is the purchase of goods from other countries. The importer is the buyer. The exporter is the seller. The import process involves several steps. Step 1 is obtaining a pro forma invoice. The importer requests a pro forma invoice from the exporter. The pro forma invoice describes the goods, quantity, price, and terms. Step 2 is obtaining an import license. Some countries require import licenses for certain goods. The importer must apply to the government. The license gives permission to import. Step 3 is opening a letter of credit. The importer goes to their bank. They open a letter of credit in favor of the exporter. The letter of credit guarantees payment. The bank promises to pay the exporter when the documents are presented. Step 4 is placing the order. The importer sends a purchase order to the exporter. The purchase order confirms the details of the transaction. Step 5 is shipping the goods. The exporter packs and ships the goods. They obtain a bill of lading from the shipping company. The bill of lading is a receipt for the goods. It is also a document of title. It proves ownership. Step 6 is preparing shipping documents. The exporter prepares several documents. These include the commercial invoice, packing list, certificate of origin, and insurance certificate. The commercial invoice shows the value of the goods. The packing list shows how the goods are packed. The certificate of origin shows where the goods were made. The insurance certificate proves the goods are insured. Step 7 is sending documents to the importer's bank. The exporter sends the shipping documents to their bank. The bank forwards them to the importer's bank. Step 8 is paying for the goods. The importer pays the bank. The bank pays the exporter. Payment methods include letters of credit, bills of exchange, and wire transfers. Step 9 is taking delivery of the goods. The importer receives the shipping documents from the bank. They present the documents to the shipping company. They take delivery of the goods. Step 10 is clearing the goods through customs. The importer pays customs duties. The goods are inspected. They are released. Now, let me explain the procedures for export trade. Export trade is the sale of goods to other countries. The exporter is the seller. The importer is the buyer. The export process involves several steps. Step 1 is obtaining an export license. Some countries require export licenses for certain goods. The exporter must apply to the government. The license gives permission to export. Step 2 is receiving a pro forma invoice. The exporter sends a pro forma invoice to the importer. The pro forma invoice describes the goods, quantity, price, and terms. Step 3 is receiving a letter of credit. The importer opens a letter of credit. The exporter's bank notifies the exporter. The letter of credit guarantees payment. Step 4 is receiving a purchase order. The importer sends a purchase order to the exporter. The purchase order confirms the details. Step 5 is packing and shipping the goods. The exporter packs the goods. They arrange for shipping. They obtain a bill of lading from the shipping company. Step 6 is preparing shipping documents. The exporter prepares the commercial invoice, packing list, certificate of origin, and insurance certificate. Step 7 is presenting documents to the bank. The exporter presents the shipping documents to their bank. The bank checks them against the letter of credit. Step 8 is receiving payment. The bank pays the exporter. The payment may be made immediately or at a future date. Step 9 is sending documents to the importer. The exporter's bank sends the documents to the importer's bank. The importer receives the documents. Step 10 is completing customs formalities. The exporter completes export customs formalities. The goods are inspected. They are cleared for export. Now, let me explain the important documents used in foreign trade. Several documents are essential for foreign trade. The bill of lading is the most important document. It is issued by the shipping company. It serves three purposes. It is a receipt for the goods. It is a contract of carriage. It is a document of title. The holder of the bill of lading owns the goods. The commercial invoice is issued by the exporter. It describes the goods, quantity, price, and terms of sale. It is used for customs valuation. The packing list is also issued by the exporter. It shows how the goods are packed. It lists the number of packages, weight, and dimensions. The certificate of origin is issued by a chamber of commerce. It proves where the goods were made. It is used to determine customs duties. Some countries have trade agreements. Goods from certain countries pay lower duties. The insurance certificate is issued by an insurance company. It proves that the goods are insured against loss or damage. The letter of credit is issued by a bank. It guarantees payment to the exporter. It protects the exporter from non-payment. The bill of exchange is a written order from the exporter to the importer. It instructs the importer to pay a specific amount. The pro forma invoice is issued by the exporter. It is a quotation. It describes the goods and terms. It is used before the actual order. The import license is issued by the government. It gives permission to import certain goods. The export license is issued by the government. It gives permission to export certain goods. Now, let me explain the terms of sale used in foreign trade. There are standard terms called Incoterms. Incoterms define the responsibilities of the buyer and seller. EXW means X works. The seller makes the goods available at their factory. The buyer pays all transport costs and risks. FOB means free on board. The seller delivers the goods onto the ship. The buyer pays for the main transport, risk transfers, when the goods are on board. CEF means cost, insurance, and freight. The seller pays for transport and insurance to the destination port. Risk transfers when the goods are on board. The seller is responsible for insurance. CFR means cost and freight. The seller pays for transport to the destination port. The buyer pays for insurance. DDP means delivered, duty, paid. The seller pays for everything. The goods are delivered to the buyer's door. The buyer has no responsibility. Now let me explain the methods of payment in foreign trade. There are several methods of payment. Advance payment is the safest for the exporter. The importer pays before the goods are shipped. This is risky for the importer. Open account is the safest for the importer. The exporter ships the goods. The importer pays later. This is risky for the exporter. Documentary collection is a compromise. The exporter sends shipping documents to their bank. The bank sends them to the importer's bank. The importer pays or accepts a bill of exchange. Then they receive the documents. Documentary credit is a letter of credit. A bank guarantees payment. This is safer for both parties. The importer's bank promises to pay if the exporter presents the correct documents. This is the most common method for international trade. A common exam question asks you to describe the procedures for import trade. Here is a sample answer. The import procedures include obtaining a pro forma invoice, obtaining an import license, opening a letter of credit, placing the order, shipping the goods, preparing shipping documents, sending documents to the importer's bank, paying for the goods, taking delivery, and clearing customs. Each step must be completed correctly. Mistakes can cause delays and additional costs. Another exam question asks you to describe the procedures for export trade. Here is your answer. The export procedures include obtaining an export license, receiving a pro forma invoice, receiving a letter of credit, receiving a purchase order, packing and shipping the goods, preparing shipping documents, presenting documents to the bank, receiving payment, sending documents to the importer, and completing customs formalities. Exporters must follow these steps to ensure they are paid and the goods reach the buyer. Another exam question asks you to explain the important documents used in foreign trade. Here is your answer. The important documents include the bill of lading, commercial invoice, packing list, certificate of origin, insurance certificate, letter of credit, bill of exchange, pro forma invoice, WW. Import license, and export license. The bill of lading is a receipt, contract of carriage, and document of title. The commercial invoice shows the value of the goods. The certificate of origin proves where the goods were made. The letter of credit guarantees payment. Let me give you a quick summary. Foreign trade is the exchange of goods between countries. Import trade brings goods into a country. Export trade sends goods out. Import procedures include obtaining a license, opening a letter of credit, shipping, and clearing customs. Export procedures include obtaining a license, receiving a letter of credit, shipping, and receiving payment. Important documents include the bill of lading, commercial invoice, certificate of origin, and letter of credit. Incoterms define responsibilities. Payment methods include advance payment, open account, documentary collection, and documentary credit. Keep reviewing. Keep practicing. See you in the next topic.